Hi, good evening all. In this video, I'll give some gist of understanding on how to look into a market and how to understand and how to uh, understand how the market moves and what should be taken much ahead. So, the first thing to understand is the market has a lot of opportunity. So once you log into your broker account, you don't have to just straight away dive into the market and look for a trade, whether it is buy or sell, and then no, you just don't have to make in a hurry. So the first thing is you just have to instead of taking a lot of trades, it's like fishing. Every day it can be a fishing day, but every day you cannot come back with fish. So there are days where you can be with empty hands as well. So especially for the intermediate or the beginner traders, whoever comes in the market, uh, the advice is not to do scalping or intraday, in the sense not to trade in a time frame anything that is less than 15, um, anything that is less than 15 minutes. So 10 minutes, 5 minutes, and anything below that, it's highly for professionals, and where the professional can easily understand the market structure just by a glance of it, and then they'll be very quick enough to make entry and exit positions as well. So especially the 1 minute candle, just before you think, process your brain process what to be done, uh, you try to move to the next area. So beginners and then the intermediate traders, so you can stay away from the 15-minute candle. Once you get the grip of it, then you can start with that. So that's one thing. So always don't be in a rush to dive in, and to understand how big a market is, and how much opportunities it is there. I have some data, let me show that as well. So, and much before that, um, so yeah, let's straight away go there. To understand that, I have started with the gold data. So I have taken some data from investing.com. So you can just go in and take some historical data. You can just put some date range and then take daily, weekly, and so on. So that I have pumped into my Excel sheet. So this is a weekly data of gold from Jan 2012 to December 2022, 10 year of data. So just have open, close, and high and lows. And here I have taken an absolute value of close and open of this, and then this J column with an absolute value of high and low. So the high and low is one minute. See here. Yeah, this is okay. Fine. Considering this green candle, so the body of the candle is open and high, whereas the wick is high and low. So to understand this range, the body of a candle, either it can be green or red candle. So to that range data, I have did an absolute value of open and close, and then to understand the overall range of a candle for the high and low for the both bear and bull candle, that I did absolute value over here. So then with these, I have taken an average. To find an average, I did a median of them. I didn't take an average. The reason is because the range of the values in this I and J column are very higher ranges and lower ranges as well. So if you see here, there's a $25 absolute value, and here there is $1, and here if you see there is a $5 as well. So the average, taking an average will not be a right metric. So considering median would be a more appropriate one than the average one. So I've taken the median of column I and column J as well. So out of the 10 year of data, on an average weekly, gold moves $16 and 43 cents to $38 985 cents. So this is like open and close, which is this area, And if you consider from week to week, on an average, gold moves 380.98 dollars, which means in pips it is 1643 pip to 3898 pips. In gold, every pip move, example, if you consider you traded with a standard order, so one pip move gives you $1. So in that scenario, the total pip value would be like $1,643 to $3,898. So this is one big, a big move in here weekly. So now I have taken a data in the daily, again for the last 10 years of one, in which in which you could see that daily basis the market moves 680 pips to 1692 pips. So this is enough pip where, assuming like in case if a trader is jumping straight away down into intraday or scalping, where he is trying to capture every moment of a candle and every pip, like so 10 pips, 15 pips and so on, and then in the moment of a next one or two candle, then he is coming out of trade and then making profit. Instead of that, if he understands that how big the market moves in a day or how big the market moves in a week, then that would be great to understand that how patient a trader can wait so that he can try to absorb the maximum portion of that moment range in a day, so that you don't have to be in a rush or in um, mental breakdown, taking multiple trades and then waiting for the candle to close and looking at the monitor for a very long hours. So this daily it gives you like 680 pips to 1692 pips. Given that, I have another one more chart where I've taken the last year from March 2020 year to March 2023, that's the last month. So in that, if you see, actually here this daily I've taken which last 10 years, that includes the year where there was a pandemic as well. And here this is last 1 year, and if you see here, the pip moves from in a day from 1051 pips to 2457 pips. So if you see 10-year data and then last 1 year data, like 680 to 1600 range, and if you see here 1000 to 2400 range. So you have enough sufficient if you consider the lower band as well. So 600 to 1200, 1600, give or take. So you have enough space or enough room so that you don't have to take multiple trades in a day, so that you can grow your fortune or grow your bank account. Instead, wait for the right opportunity and then take that one. And if you have enough risk reward ratio, anything risk reward ratio which is from 1 is to 2 or above 1 is to 2, is a very good trade. You can just take only 2 to 3 trades and make an equivalent money where you make multiple trades and make the same fortune. Say, for example, you make 15 trades in a day and then make some $500. Instead, you can take 2 to 3 trades in a day and then make the same $500 with having less pressure over your brains as well. So this is how you understand how much opportunities are there in the market in a daily basis. You plan your daily risk and then reward, so that will in return pay you how much weekly you will get it, and then that in return you can have your monthly targets to make it as well. So this you can do it on multiple scripts as well, based on your interest and so on. So here I have added only few variables into this example, and there are other parameters as well where you're considering the tight spread or not, and so on how experienced you are in trading and so on as well. The other script which I have taken is the crude oil. So this is again for the last 12 years from Jan 12 to December 22 weekly data, which I've taken from the same investing.com. The same math here and then the same math over here as well. We see on an average weekly it has moved 167 pips to 389 pips. The crude oil is different. So whenever you take a standard order, so one pip move gives you a $10 as a profit or loss. So just multiply it with 10 over here, which gives you 1675 to 3895 pips a week. Sorry, dollars a week. So if you are trying to capture the entire from neck to neck all the possible positions, which is not possible though, but the range is so high that you don't have to straight away, as I said, you don't have to try to catch every possible trades. Instead, wait for the proper trade and then catch one or two trades with proper risk reward ratio, with which you can make the same amount of returns, where you make with multiple trades and sit in front of a monitor for a very longer hours as well. So this is point number one which I have to make it, and those are point number two. So the next thing is, whenever you wanted to trade in a lower time frame, anything that is less than an hour or 4 hour, so always the trend in the lower time frames is bound to the trend of a higher time frame, and the trend of a higher time frame is decided by a trend of a lower time frame as well. Sorry, I think I'm confused myself as well. So let me show in the chat now. So this is a gold one. So this is a gold chart. If you see here, let me go to weekly. Yeah. So this is daily chart and this is a weekly one. So higher time frame. So if I say here low and this is high and this is higher low. If you see in a daily time frame, the the trend in the lower time frame in daily, it is bound to the trend in the higher time frame that is in weekly. So if you see, let me squeeze this a little bit and then yeah, here go. You see here, you see the crosshair symbol in the both the charts. So the weekly I'm at low. If you see here, it goes up higher high in daily here this area, then higher low, then again it goes to higher high, then again higher high. So daily here it is double bottom and the neckline is broke here. So in weekly it was an impulse wave after the double bottom neckline break here. It was an impulse. So in this bull trend in the daily, the market will also be in a bull, but it goes in a zigzag manner like low, high, higher low, higher high, higher low, higher high, higher low, then again higher high, higher low, higher high, higher low, previous high, and then there's a neckline break actually. We see this entire stretch in weekly. In daily, it was a swing, it was in bull. So the trend in the lower time frame is bound to a trend in the higher time frame. So always when you're trying to make a trade in the lower time frame, look for what is the trend in a higher time frame. If your higher time frame is in a bull trend, and look for whether in which wave we are in. Like for example, are we in an impulse wave? Are we in a corrective wave? So this is an impulse wave. So the movement of a market in the impulse wave will be faster, whereas the movement of the market in the corrective wave will be slower. If you see, this is a corrective wave and this is an impulse wave. If you are an impulse wave, this will be much faster. The market will move at a higher pace. In a corrective wave, the market may take slow down a bit and then slowly start correcting for the this bull trend actually. If you see here, there is a double bottom neckline break. I'm sorry, double top neckline break here. The trend has reversed over here. Since the trend is reversed here, from here the market has fell in weekly as well. So daily this is the trend downtrend. So for which the weekly has fell from top as well. And here again lower low, again is lower high, then again it is lower low, lower high, previous low, then neckline has broke. Once the trend is reversed over here again, the trend is buy over here. So from here again the market has rallied here, and then the market is fully rallied up top here. You see, I'll just change it over here. You see, I've drawn a red line over here, and that red line. You see, this is the um, trend in the lower time frames as well. So this is one part, and understanding this. Sorry. Okay. So this is one part. Now I am in a daily frame now here. Now here I have drawn a swing here. You see here, the possible directions of the gold and root I have already explained in my previous video. If anybody want to have a look, you can just go ahead and have a check here, there as well. So here I have mentioned that the market is in ascending channel as well as an ascending wedge. You see here the market is in uh, wedge for now instance. So channel is also a good thing to explain, but consider this as a wedge here. So now here, if you see higher high, then higher low, then higher high. If you see this high is broke here, the market is higher high, this candle, green candle, then again higher low, then again higher high, then again now it's in higher low. So this is in a proper wedge movement. Now this is in daily time frame. Now see how what happens in 4 hour time frame. High, low, high, higher low. This is like previous high. Then again it's like double bottom. Then travels inside. Then again it goes high. If you see here, this high range has broke this area. Then higher high. Then higher low. Then again this is broke. Then higher high and then again higher low. You understand that the market in daily is an ascending wedge where the market keeps pushing itself up, up, up. In 4 hour, again the market is in trend high as well. Now consider this area, the most recent one, and the last Thursdays and Friday moment of the market. Let me mark them in. Let me mark them in black. Okay, that's all. Now let's go to 1 hour. So if you see an hour here, the trend is here down here in this area. This one. This is a downtrend here, but if you see in a 4 hour, that higher time frame of 1 hour are considered as a 4 hour. If you see there, if you see this is higher high, low, higher high. Is it has broke this high here? Let me draw that again. This one. You see here, low, high, higher low, but these lows in 1 hour it's a downtrend. So if you understand that the trend of a market in higher time frame that's in higher high, and I have got a trend reversal in 1 hour that it has broke the low here and then it's going down. You can say that for the 4 hour this is an impulse wave. Now the market is in a corrective wave in which you can go for a sell opportunities until you have a trend reversal where this trend here lower low has broke up here, and then the market is returning to its trend up, and then here again the market from here it has pushed itself up for the resistance area where there is a wedge here up top, and at this area if you see here in 1 hour, sorry, the market was higher high, higher low, then again this high is broke up here, then a higher high, then here we see it's a double top here, these two double top here, neckline is break here, and then it fell. It was very no, it felt like a meteor from the sky in a single shot, and then here it started slowing down, and then now it's the reason is because here we have wedge support, and then the market started slowing down at this area as well now. So if you see at the lower time frame and the higher time frame, if you put it together, you will understand in what direction of an higher time frame that the lower time frame market is moving in, whether are we in impulse wave or whether are we in a corrective wave. If it is an impulse wave, we can just stay in the flow. It's like you are traveling in a course of a river, so you don't have to put much effort, so you'll travel along with the river. The corrective wave is a place where you are traveling against the course of a river, where you have to put more effort and maybe you might even fail in that as well. So always be with the trend and go with the flow. So I'm not saying that you cannot trade with the corrective wave. So the corrective wave at 4 hour, but in case if you go for the 5 minutes or 15 minutes, if you see what I have drawn over here, you can see a lot of opportunities in here. So in here, so understand the trend in 30 minutes or understand the trend in an hour and 4 hour. Then based on that and based on the risk reward ratio and your risk appetite and the account, what to say, your account, how much you have in your account, and then your spread on your provided by your broker and so on, you can take a decision on that as well. So always understand the trend of your analysis time frame, or in which time frame you want to trade. Understand the trend of that time frame as well, and then its higher time frame, one or two time frames, so that you will be able to understand in which trend are you traveling in, and how better, or how what is the probability of success of a trade would be in case if in which direction you are trying to move in. So that was the thing which I want to explain on the time frames as well. The last one is focus more on the technical analysis, like support, resistance, swings, patterns, um, Fibonacci retracements, and um, the patterns like triangle, wedge, flags, and so on. And don't stress more on to the signals and indicators like um, MCD indicators and trend indicators or moving averages and so on. Consider them as you take as a salt in your meal. So because these indicators will just indicate you what could happen there, but not exactly what exactly they don't give much um, what to say more confirmed thoughts on how the market will behave, so on. So the technicals will help. Indicators is just a consider with the technicals. If your indicator is also supporting your technical analysis, consider them as, so it's like an additional confirmation on whether you have to take a trade or not. So that part you take it in. And that's it for today. So in case you have any other thing to discuss with, or you want me to explain anything else, just drop your comments there, and maybe the next upcoming videos I'll cover up those parts as well. So keep in mind, as a conclusive part, so understand your trend in your higher time frames before you take your trades, and there is a plenty of opportunities. Understand your daily movement of any instrument you want to trade, and so that you can understand like how much fortune you can make out of that particular range bound market movement. And don't try to make more number of trades. Instead take few number of trades, and then which will be equivalent to your making more number of trades, and the fortune you make in that more number of trades, you can make it in few number of trades as well. And also will have a peace of mind as well, and focus on more on technicals. Let me know if you want to make any more videos on, if there's any technical analysis you wanted to do it. I'll just brief something, and then I can post more videos on that. Thank you. Happy trading. See ya.